Somebody had glitter on her floor.
Okay, so today, hello, focus. So we're going to be talking about
All right, so welcome to Community Lending's More Than Mortgage podcast. What are we talking about today, Deanna?
well, definitely not hurricanes
Okay, good. Thank you, Lord.
because I am done with them.
Yes, ma'am.
All right, so we're going to talk about something different today. We're going to talk about options and affordable solutions for home buyers with the rising rate environment and some of the solutions we have to help people get into a home and maybe date the rate but marry the house.
Date the rate, but marry the house.
Date the rate but marry the house, yeah.
Right? All right, so how can we make payments more affordable for buyers?
So there's a great program called a 2-1 buy down or a 1 buy down, a 1-0 buy down. So the 2-1, basically what it does is, and I try to put this in terms that anyone can understand because it's marketed like it's buying down the rate. And that's really not what's happening. With a buy down, what happens is you take a certain portion of the seller's proceeds and you fund an escrow account that then subsidizes the borrower's
Makes the payment more affordable for a fixed term.
So it's not an adjustable rate mortgage.
Right.
It's not a lower start rate mortgage that progresses to a higher note rate.
Right.
It's literally just the seller stepping forward and saying, I'm going to participate in this with you. And the difference between this rate, 7.5 to 6.5, is $200 a month in savings on a mortgage payment, right? And so we're going to take that 200 times 12. That's $2,400. That's going to go into this escrow account, and every month we're going to pull $200.
Make your payment less money
for a fixed period of time. So a 2-1 is fixed for 2 years. So what happens is, it's funded for 2 years. The first year, you have a more significant savings.
Yep.
So it discounts the rate or the payment 2%. And then the next year it's 1%.
Okay.
And then the following year on the 25th month, it goes to the fully indexed, wrong word.
The actual interest rate, the actual payment.
The actual payment.
Which you're going to know up front. That part's not going to change.
Yeah, so there's a lot of negative connotation, like, oh my God, it's so scary. It's an adjustable rate mortgage, and it's absolutely not.
It's a fixed rate.
It's a fixed rate mortgage.
The seller's just making a portion of your payment every single month for the first 24 months or 12 months, depending on what option you choose.
Correct.
Okay.
And you can use this particular program with any type of loan. So it can be FHA, it can be VA, it can be a conventional loan.
Okay.
You can also do it with ARMs. Now there's rules around how you structure it when you're using an ARM loan, and so there are some restrictions there, but it's broadly used, and it gives the borrower the ability to make that payment more affordable while these rates are up. Yep. And I think a lot of professionals, myself included, I believe that when we go into the recession, within the next, I'd call it 12 to 18 months, we're going to see rates pull back. And at that time, it might be the opportune time to go ahead and refinance and get out
into a lower fixed rate.
And here's the really cool feature.
It's money in the bank.
So you're right. So say you're 1 year through your 2-1 buy down, and there's, I don't know, $3,000 left sitting in the escrow account. It gets applied towards your payoff of
if you pay it off or you refinance,
correct,
you get that money back.
Yeah. So it's a win-win. Okay. That's one solution. And then we have this really cool program that we came up with at Community Lending Lower, and it's called the S.O.L.D program.
What's that stand for?
So it's a permanent buy down of sorts. Okay. And where I think the real pickup is here is more for the listing agent and the agents when they're talking about marketing properties and they're looking at, like, how can we help more people? How can we expand the pool of buyers that could qualify for this house?
Right.
And so basically, in a nutshell, what we do is we take a certain portion of the proceeds and we apply it towards a permanent buy down, which effectively makes the guy that might have been pre-approved for a $408,000 mortgage. Now he's able to afford a $450,000 mortgage because the rate is lower than what we were originally pre-approved.
So this is just like a seller-funded
seller offered lender discount points.
Awesome.
Yeah.
S.O.L.D.
Sold. Seller offered lender discount points. So really cool features for sellers trying to sell their home and looking for that edge to help them stand out in the MLS, and a really huge opportunity for buyers that might have a hard time qualifying, or maybe they're not finding anything in their specific price range. So utilizing this strategy, we can help show the listing agent how they can structure the deal to make sure that the buyer gets the most benefit for themselves and also the seller. So it's a win-win-win for everyone. I think it's important to note that it is a seller concession that funds this account. So you hear people say, well, anybody can do that. And that's somewhat true. The part where that's important to understand is how to structure it so that you pass the ATR rules, which if you're listening to this, you probably don't know what that means. But there are some restrictions that you have to come across to be able to offer this and offer it right. And so you want to make sure you're working with somebody reputable that can help you make sure the loan is structured properly and that you actually get to the closing table. Someone local. Right. You know how I feel about local after the hurricane.
Absolutely.
You should do everything local.
So the best thing someone could do is go to our website, Community Lending, and hit the team button and find your favorite loan officer on that page.
Yeah.
Give them a call. It doesn't cost anything, and ask about the options.
Just whatever you do, don't pick that guy.